What's up, guys? Andres here from the Strong Family Money Show. In this episode, I'm going to show you how to make sure your money is spread out evenly and correctly among all your investment vehicles. I usually upload these by themselves on as parents, and you not have a plan tube in your Disney Plus and all that stuff on your computer, right? You can use, and when you're in a caloric deficit, to try to. So in the last episode, I spoke about risk tolerance. Whether you're, what side of the spectrum are you on? Are you low risk tolerance, right? Is your tolerance of risk low? Do you want to keep your money as safe as possible? Or is your risk tolerance high? Is your tolerance of risk high? Can you tolerate more risk, right? That means you want to see more return on your money faster. So with that, I mentioned, you have to find a vehicle where you can put your money, where all this can take place. Along with that, you have to take into consideration asset allocation and diversification, right? So you have to know where to put your money, and when you put your money where it's supposed to go, how to make that money work for you. Okay, so these two terms may be a little confusing and interchanged. Asset allocation is where you put your money, right? So the three basic ones are cash, bonds, and the stock market, right? So those are basically the three that everybody does, right? If you want to throw investment property in there, like real estate, you can. But most people, because they have like employer 401ks or stuff like that, those are basically the three that everyone has. You have some in cash, you have some in bonds, and you have some in the stock market. So that's great, right? So you have those three. So when you look at asset allocation, you have to determine how much of each you want to put your money in, right? Do you want a large cash of cash available, right? Do you want to have lots of money in a safe investment like bonds, or do you want to have most of your money in something like the stock market, which is a lot more volatile, but the return on your investment could potentially be higher than the other two? I would say cash would probably be the least desirable of the three, only because it does nothing but sit there, and the longer it sits there, the less value it has, right? Inflation will affect it more, right? But if you have it in some sort of vehicle that appreciates over time, you at least want to have it in something that will take care of the price of inflation, but it won't lose money in the long run if everything goes according to plan. And that's the caveat with anything when you do with investing, is everything has to go according to plan, right? So asset allocation is what vehicles you're going to put your money in, and how much are you going to put in each of them, right? So you have to decide on your own. I have this much money that I can invest. I have this long to have this money work for me, and I handle emotions, because money is very emotional for people. I handle emotions well or not so well. So then all that goes into what and how much money you're going to invest in each of those things. Now, diversification, and people will confuse. So this next one, diversification, people think diversification is cash, bonds, and stock market. And to a degree it is, but diversification is, okay, so now I have, cash, right? So do I put my cash in just a regular bank? Do I put it in a high yield savings account where I get penalized if I take it out? Do I put it in some sort of, and you can, some sort of account that gives more return the longer I put it in, like some sort of money market account, right? So then you have bonds. Do I have municipal bonds? Do I use, private company bonds? Do I use them for 10 years? Right? So there's still some decisions you have to be made even in the vehicles you choose, right? And that's diversification. So if you take the stock market, for example, if you put whatever percentage you want in the stock market, you still have to decide what you're going to put it in. So you have to spread out your money that you're putting into the stock market over other things, right? You might want to put some money into some, startup company. You like Apple, put some money there. Do I want to put most of my money into some market funds, right? So there are funds that just say, we're going to take every stock that's in the NASDAQ, every stock that's in the Dow Jones, right? Or you can do them, they do them by sector also. So these are all the energy stocks that are on the market. So that's called a market fund. So you just give them money, and then the people that run the fund, and you want to find some that have low fees. You have to take fees into consideration when you're doing all this anyway, right? So then you just give them your money. They spread it over the whole whatever sector they're investing in, and as long as the sector does well, then the fund does well, right? As opposed to investing in Apple, you're taking your money, you're buying a stock in Apple, and your money only grows when Apple does well. And Apple is an example of, it's going to do great, but share price of Apple, for someone to do some sort of financial planning with, you have to buy quite a few shares, and this to some people may be cost prohibitive to do that. So diversification is mitigating your risk even further from asset allocation, because then you take whatever money you're going to invest in that asset, and then you're spreading it even further across more things, so that the market affects, or the economy or market, whatever you call it, affects you even less, right? So those two things, so actually the three things. So in my previous episode, I spoke about risk tolerance. So these three things: risk tolerance, asset allocation, and diversification, are the trident, the triangle of personal investing. And you have to understand and work with all three of those things when you're investing your own money, because it's your money and you work hard for it. But those are the things that if you give your money to somebody else, right, if you pay for a financial advisor, right, those are the three things they're going to do anyway. So learning what they're going to do on your own, so you can potentially do it on your own, and it really isn't that difficult. It is important. So risk tolerance in my previous episode, asset allocation, what vehicles are you going to use to grow and save your money, and diversification, right? How are you going to mitigate risk even further by spreading the risk out over other vehicles in the area that you're going to invest in. So with these two videos, the one previous and this one, that gives you a starting point on taking care of your own money and how to attack your personal investing. If you find this helpful, let me know, so that I know that this type of video is something that you guys are interested in. Please like and subscribe. Share with people who you think this will help. Also, I'm Andres from the Strong Family Money Show. Thanks for watching, and I'll talk to you guys next time.